Hi Ronald, it's Jason Watt here from Business Career College. Just with an answer to your question about the calculation of guarantees and taxation with a segregated fund contract or an individual variable insurance contract. This is probably the most difficult bit of math that students run into on the exam, and a couple of challenges here. This is a very complicated question. It's a multi-part question. The nice thing about those kinds of questions is that generally, once you answer one part, the second part is more obvious or easier to arrive at. So you're generally not going to get sunk on a multi-part question if you know how to do one part. The other challenge here, of course, is that students do just have a tough time with questions like this where there's a lot of numbers and math in the question. That's how it goes. I recommended this earlier. I'm not sure if you're following my advice or not, but certainly appropriate to start with any kind of question, especially where you have a bunch of data in the question stem with that last sentence. So in this case, you would start solving the question at, quote, using the proportional reduction method, what would be the minimum Austin will be given, etc. So based on that portion, we know that we're being asked what his minimum guarantee is based on the proportional reduction method and how much capital gains tax he would have to pay. The real challenge here is just understanding what a proportion means. So in this case, the first thing to do is to establish what the proportion is. The proportion is $7,000 out of a possible $15,600. Austin could withdraw no more than $15,600. He has withdrawn $7,000 of that, about 45%. If you want to go to more decimal places, you can do so. You'll get answers that are a few pennies off, but it's not a big deal. If you just use 45%, you'll be in good shape. So once we see that it's a 45% withdrawal, we can proceed from that point. We say $10,000 less 45% is how we calculate the basis for a new proportional guarantee. So now $10,000 less 45% is $5,500. So his guarantee is going to be based on $5,500. Of course, had he exercised a reset at some point, so let's say he had reset when the contract was at $15,600, it would change his guarantees. But he didn't do so, so it doesn't affect his guarantees. His guarantees are still going to be based on the original $10,000 that was invested. So now we take that $10,000 less the 45%. It gives us $5,500. 75% of $5,500 is $4,125. Until he exercises a reset, his guarantee is going to be $4,125. Now, in addition to that, he has tax consequences. His tax consequences are going to be calculated much the same way. If he had taken out the whole amount, he would have $5,600 of gains. But he didn't take out the whole amount, so we take that $5,600 times that 45% that we early established as the proportion withdrawn. We end up at a capital gain of $2,520. Now capital gains, as you'll recall from Module 6, are only taxed at half, sorry, from Module 5, I apologize, are only taxed at half the rate of regular income, so we end up with a taxable capital gain of $1,260. Buried in the question with all the other detail that's in there is Austin's marginal tax rate, which is 36%. $1,260 times 36% lands us at $453.60. That's the amount that will be included in income. I hope that helps. Like I said, a very complicated question. You shouldn't anticipate too many of this type of question on either your certification exam or your provincial exam. But it's not uncommon to see one or two. And one of the challenges I find with these questions is that students really get hung up on them. So my advice is, if you can get to an answer, that's great. But seldom do people pass or fail these exams just by 1 or 2%. So don't get bothered by one question that causes you an exceptional amount of difficulty. Spend a minute and a half on the question. If a minute and a half is not enough, you have to recognize it's time to move on. You can come back to it if you have time at the end of the exam. If not, well, you know, you're going to study it again later on. It is a concept you should be familiar with. It's useful to understand how the taxation of IVICs work, especially if you're going to do a lot of IVIC business as an agent after you're licensed. Thanks very much. Have a great day.